We're very glad to have Larry and Paul with us, the two giants in our field. Thanks again for both of you. And Larry, the floor is yours.
Marcus, thank you. And thank you for the terrific public good you have provided through the Marcus Academy. I'm glad to be here for this discussion. Let me be clear at the outset what I think we're discussing. Some of this, I suspect, was set off by my Washington Post column about 10 days ago. I don't, as an economist out of government, have views as to what the right political strategies are. And certainly I've got enormous respect for President Biden and the very, very serious and able people who comprise his economic team. And I think it is clear that it is urgently important to provide relief so that we do not have a K-shaped recovery. It is urgently important that we support aggregate demand through the period ahead. That the lesson of the last years is the importance of using fiscal policy aggressively. Indeed, that's been a central aspect of my secular stagnation thesis, that at a moment like this, it's better to err on the side of doing too much than to err on the side of doing too little. These, though, are qualitative arguments, very compelling qualitative arguments that could be used in support of a $1 trillion program or in support of a $5 trillion program, and could be used in support of programs with a variety of different compositions. I find myself rather surprisingly at this moment a bit like a long-term advocate of the minimum wage and increases in the minimum wage, who discovers that the federal government is now proposing to raise the minimum wage to $23 for a year or two. On the one hand, approving of the broad impulse. On the other hand, very much wondering about the design and timing of the proposed policy measures. Let me make 4 points that encapsulate my concerns. First, what is contemplated is extremely large. I don't think there's any question that in retrospect, it would have been better if fiscal stimulus had been larger in 2009. The Obama administration basically had that view and wasn't able, and asked questions about the tactics, to legislate that through the Congress as it stood at that time. But I think what's important to recognize is that, as the first slide illustrates, the proposed stimulus here is far larger relative to the gap. Previous one, Marcus, is far larger relative to the gap than anything that was undertaken in 2009. Yes, 2009 was too small. Was it too small by a factor of 5? That's not an argument I've heard previously. Similarly, the proposed stimulus is much larger than the stimulus or support program that was contemplated in 2020. So at 14% of GDP in new measures, at a cumulative budget deficit approaching 20% of GDP, we are in extraordinary territory. Second observation, this goes way beyond what is necessary to meet the absolute imperative of relief. There is no question that there is tremendous suffering because of COVID's direct and indirect consequences, and it is government's obligation to meet that need. But if you remember only one number that I say, remember this one. Income, wages and salary, total income is running about $25 billion a month below an optimistic projection of where it would have been without COVID. $25 billion. In contrast, if you look at the unemployment insurance, plus the checks, plus the child credits, plus the rental assistance, which is small, you spread that out over the whole year, you are getting a number that is in excess of $100 billion a month. That's why it's projected that disposable income for households will be well above traditionally projected levels. Of course, it's probably more important to look at the lower income populations, but because the assistance is targeted towards the lower income populations, as the next slide illustrates, the magnitude of the assistance relative to lost income is much greater than it is for the population as a whole. This should not be surprising. Unemployment insurance is going to provide greater incomes than employment did for nearly 2/3 of those who are unemployed. And whereas unemployment insurance normally reaches half the unemployed, now the number of unemployment insurance recipients is slightly in excess of the number of people who are unemployed. Similarly, Jason Furman and others have calculated that if you look at state revenue shortfalls, they are dwarfed by the combination of the assistance in December and the assistance proposed now. And so we are doing far more than is necessary to meet our obligation of addressing the victims of COVID. Is this wise? There are, I think, two reasons for believing that we could be passing much better legislation that would do more for our economic future. The third point I would make is the point that Olivier Blanchard has made and that has been implicit in questions that have been raised about the Fed's current approach. We risk an inflationary collision of some kind. Paul very perceptively, writing in November, predicted a Biden boom reminiscent of Morning in America at a time when it was in doubt whether there'd be a lame duck stimulus, and before the Georgia outcome, it was inconceivable that anything like the front-loaded $1.9 trillion program would be put forward. He was right, given the expansionary financial conditions, given the likelihood that we will, by the midsummer, put COVID in the rear mirror, given a very competitive dollar. To take a potentially booming economy and to put on top of it $1.9 trillion of stimulus is to take real chances of a kind that I don't believe we need to take. The historically remembered LBJ guns and butter collision involved excesses on the order of 1 to 2% of GDP. We don't know enough about the Phillips curve. We don't have enough experience to make confident forecasts. But when we are speaking of fiscal actions of this potential magnitude on top of an economy that quite likely would be booming with no further fiscal stimulus, we are, I believe, taking imprudent risks. The prospect has been held out that the Fed can manage any problems that arise. That is not my reading of the historical experience. My reading of the historical experience is that almost every time the inflation has accelerated and the Fed has felt it necessary to step in to prevent inflation from accelerating, the result has been that the economy has gone into recession. The Fed has had essentially no success in engineering soft landings. Every time unemployment has risen by 0.5%, it has risen by 2%. And so the risks are very substantial of collision. Those risks might be worth running if that was necessary in order to provide relief, but it isn't. They might be worth running if this was all that was at stake. But, and this brings me to my final point, the centerpiece of the president's campaign, rightly, was a program of building back better through large-scale public investment in preventing climate change, in infrastructure, in education, in the caring economy. And what's contemplated is trillions of dollars of further investment on top of a situation that is potentially problematic in terms of its aggregate demand impact. What should happen instead? There's nothing wrong with a $1.9 trillion target or even a larger target. But the emphasis should be on public investment and building back better, preparing us to protect the climate, preparing us to compete with China, preparing us to be a more just society. As many economists have advocated, there's an important role for triggers. I could be wrong. It could turn out that COVID is much longer lasting than now looks likely. We've seen that Congress can be dysfunctional. Triggers that would increase unemployment insurance, if that were to happen, or in extremis would provide benefits to households, would be appropriate.
So
but a much better program, I'm just stopping, a much better program would be a program that was focused on meeting necessary relief needs in a targeted and efficient way, focused on public investment with contingency triggers if the economy were to turn down. That would be a better basis for durable prosperity.
Thanks a lot, Larry. You made a very strong point that the size, essentially, if it was spread over the years and it were more investment focused, I guess it would be different in terms of inflation expectations. Paul had recently revived his blog and had a very nice first entry in his new blog. And so we're very glad to have him back in the blogosphere. And I'm sure that Paul has his own perspective, and I'm curious to find out, we all are curious to find out what his perspective is on this Biden stimulus.
Okay. I found myself remembering some physics history as getting ready for this discussion. A very young Wolfgang Pauli, after hearing a presentation by Albert Einstein, said, what Professor Einstein has to say is not entirely stupid. So what Larry had to say is not entirely, no, I mean, I think there's a very serious point, which is that we should indeed be thinking about the macroeconomics of this big program. But I have a quite different take, and I think it is not to say that Larry's concerns are entirely off base, but I think that they're exaggerated, and you do need to think about what are the actual alternatives here. So I think the first thing to say, which I've been trying to say since the very early stages, but just doesn't seem to get through, is that this is not about stimulus. We are not in a conventional recession. It is something, it's a combination supply and demand shock, but I don't think it really helps it. We're still essentially in a partial lockdown, which is in part the result of government policies, bans on full-scale indoor dining and so on, but largely also just voluntary. Who's going to be dumb enough to, some people will, but you shouldn't, even if it's allowed, you shouldn't be going to full indoor restaurants. And this means that we have a situation of suppressed output, which is not well described by the concept of an output gap. It is not the case that if we had sufficient aggregate demand, we would be back up to some estimate of potential output. We are rightly not doing a lot of stuff we would normally be doing. Which means that the whole framework of stimulus to fill an output gap is not the right way to think about where we are. I've suggested that we think about it as disaster relief, or in some ways it's like fighting a war. And when Pearl Harbor gets attacked, you don't say how big is the output gap. Let's size the defense budget based on plausible multipliers to fill that output gap. That's not what you do. You just spend enough to actually win the struggle that you're in, which doesn't mean, although it's not stimulus, it can nonetheless be stimulative. So there is you do want to think about the macroeconomics of it, but you do want to do that with the understanding that that's not the purpose of what you're doing. And for what it's worth, if you think of this as being a temporary emergency that requires a bunch of spending, which I think we all do, question, how should that spending be paid for? Well, this is pure standard public finance theory, which says that if you have a temporary need for a bunch of spending, you don't want to raise taxes to fully pay for it. You want to spread it out over time. So a largely deficit financed response is appropriate. Before I get into the size issue, I think it's helpful to think about where does this come from? How does the spending get to be so big relative to the output shortfall? And I don't think I don't think output gap is an appropriate framework in any case. And the size of the output shortfall relative to what you might have expected is very contingent upon what where you thought we were in 2019. And I'm not of the view that we were actually above potential output then. So there are some issues there, but it's clearly, by any reasonable calculation, we're talking about a spending package that is at least twice and probably more than that the size of the shortfall in nominal GDP that relative to what we should have expected. So what's in there? Three components. I'd say conceptually, you want to think about three components. First, there's public goods spending related to the pandemic. Shots in arms, making schools safe to reopen. Quite several $100 billion of stuff that is really quite clearly directly related to the public health emergency. It's not most of the package, but it's a significant part of it. Second, there's income support. The unemployment insurance being the most important part of that, and the income support it's a big deal. And to some extent, you want to think of aid to state and local governments as being a kind of income support. That because of our fiscal federalism and balanced budget requirements, lower levels of government are in some ways in the same position as liquidity constrained unemployed workers. They need aid to tide them over. And then the third part, there's a bunch of stuff that is not very targeted. In my blog post, I called it belt and suspenders. It's the argument for things like the checks to, to most adults, regardless of economic circumstances, are the economic argument for them is that any attempt to create criteria for targeted aid is going to have gaps in it. And certainly the unemployment benefit has gaps in it. So you're throwing out a bunch of money, much of it going to people who have not been hurt by the pandemic or not significantly hurt, but some of it also going to people who really have but are not getting aid. And so you're throwing some money at them. And it's not well targeted, but trying to be too careful can be a problem. I would be very upset if the whole program or most of the program consisted of untargeted checks, but it doesn't. It's something like a quarter of the program. So those are the three things. And if you want to think about how the program can be so big relative to the income shortfall, you want to say, well, there's the public goods stuff, which is not related at all to the income shortfall. There's the income support, which is supposed to be roughly corresponding to the income shortfall. And then there's the sort of the belt and suspenders stuff, which is on top of that. And so it ends up being a very big number. Question we should ask then is, first question we should ask is how much overheating is all this going to cause, or how much stimulus over and above what we sort of need to get through is this going to provide? The public goods stuff it's like defense spending in a war, military spending in a war. It's clearly, it's a significant just plus on demand. Necessary as it may be, it is going to be adding to demand. The income support, less so, because to a large extent, maybe not perfectly, but to a large extent, is replacing income loss because of the pandemic. And in fact, if you want to ask what happened last year, it seemed pretty clear that the economy wanted to have a secondary Keynesian recession on top of the pandemic slowdown because there was big loss of income and spillover to demand. And that was short-circuited by the CARES Act, which provided aid and meant supported incomes, and that it supported us. And it really did. It wasn't stimulus in the normal sense, but it did in fact provide a floor under aggregate demand, which was really important. But again, I don't think I'm sorry, not again. The public goods spending definitely is expansionary. The income support, I think, is largely just keeping us in place. The broad-based stuff, which is the checks, but also, I agree, it does kind of look as if we're the state and local aid in particular is bigger than the fiscal problems of state and local governments, certainly in aggregate. Those things are definitely kind of, there's a lot of money. However, it's probably not very stimulative. In fact, it's doing a lot to reassure people, as some of it is helping people in need, and the rest, I mean, I'm not a big believer in Ricardian equivalence. But if there's anything where you can expect that people will just save a temporary increase in income, surely receiving a check that is not compensating for anything and that is a one-time event, a lot of that's going to be saved. There's a fair bit of evidence that happened last year. So that the net impact on aggregate demand is not as big. You look at the $1.9 trillion, this is going to have an aggregate multiplier well under 1. It's not going to be nearly as big as the headline number would suggest. It still is a stimulus on top of an economy. Now, I do think we're going to have a boom, but I don't think it's going to happen until we've got enough vaccination for herd immunity, which means it's going to be coming late in the year. So, I'm very optimistic about late 21 into 22, but not right away. But we're putting something on top of that. And I have to say that I think it's a little, it's true that monetary policy attempting to offset fiscal stimulus actually has sometimes overdone it and led to recessions, and has sometimes underdone it so that inflation starts to take off. And I'm not sure that there's any general principle that says that we should presume that that the Fed is in a systematic way unable to handle this. But it will have to do something if things go well. If we do have a kind of booming economy. For what it's worth, which may not be much, the markets aren't acting like they're particularly worried about this, but it could be. But I think the other thing that you want to ask is, if you don't, if you're worried about this, what are you suggesting? Which pieces of the relief package, the rescue plan? I was happy to see the Biden people call it that, not a stimulus. Which pieces of the rescue plan would you want to drastically cut back? Not the public goods, pandemic fighting for sure. That's what we really need to do. The unemployment benefits are a bit, they're generous, but not as generous as the $600 a week as in the CARES Act, and it's not that the difference between what you might think was a reasonable compensation and maybe the slightly higher stuff is not a big deal. Generalized checks, yeah, the case for those is the weakest of all the pieces, but they're also not likely to have very much stimulative effect. And the same is true for any excess state and local aid. State and local governments, if they find themselves getting a lot more money than they're going to need, they're not going to have a huge boom in state spending. We're going to have a lot of it used to replenish rainy day funds. So I don't think that that's a big inflationary stuff. And the question has got to be, what are you suggesting that we cut? And of course, it does matter that the checks, which are the least justifiable piece in terms of standard economics, are also by far the most popular. And I don't think we can entirely disregard that. That's part of part of making a successful policy is making something that you can actually sell.
Thanks.
Can I just add one last point?
Sure.
Larry, I agree that the bigger thing is infrastructure investment, but I don't think that these are competing. Any excess stimulus that we're going to get now is going to be gone by the time any kind of infrastructure program is going to get rolling. Infrastructure stuff is stuff for sometime next year at the earliest. It's just not going to be a competing issue. And let's be realistic. The political economy of this, the constraint on the kind of infrastructure plan that Larry and I both want, is not financial and it's not macroeconomic. It is political. And it's all about whether we will have enough sense that government programs work to be able to do the things we should be doing next year.
Thanks a lot, Paul. There was a lot of stuff in it. Let me just summarize. So you think the framework of output gap is probably not sufficient to look at this problem. There's more income support rather than a stimulus. That relates to some resilience argument as well, where the households would like to have more resilience, more of liquidity buffers compared to earlier. We know that in the US, it's for many households, they don't have enough liquidity buffers. And perhaps they won't spend it and don't push up the inflation and hold higher liquidity buffers. We don't know. I was intrigued by your war analogy. The timing is a little bit different now, because during the war, you spend during the war when others can't spend so much in private consumption. And when the war is over, I think you have to change. Here, it depends very much how the vaccines are rolled out. But I find it so perhaps Larry can respond to it, and let's keep it back and forth short. To the questions, the explicit questions you ask, which parts of the stimulus package or the income support package to cut back on, and how do you see the resilience aspects, and how would you redesign the whole thing? And perhaps if I throw something on top of it, you were arguing for secular stagnation, which was an infrastructure, the interest rate staying low. Perhaps you can combine it with your earlier hypothesis of secular stagnation, where you always argued for more government investments in particular, and how does this fit, being now more conservative? How does it fit with the earlier hypothesis of having expansion because of secular stagnation?
So I'm sympathetic to Paul's basic framework. There's about $170 billion in there to spend on vaccines and fighting COVID, and every penny that we can usefully spend, or even half usefully spend fighting COVID, we should spend. I'm for that. Lost labor and salary income is $20 billion a month now, going down over the year. Call that $300 billion to be very generous. We should absolutely spend that. That gets us to $500 billion. There are other categories that you can argue that can be argued about, and so you might get up towards $1 trillion. I think you have a difficult time getting to $1.9 trillion. We're close to $1.9 trillion on Paul's criteria. When he defends the proposition, which he does in a persuasive way, that this may not lead to overheating, the main argument Paul makes is that the spending won't take place this year, but will take place in subsequent years. And so the demand will take place in subsequent years. I think we all mostly expect that we will put COVID in the rearview mirror by the end of 2021, and that we will have a really quite strong economy at the end of 2021. And therefore, if there's more spending on one thing, there'll be less spending on another. And I would rather we run an economy targeted towards public investment in 2021 and 2022 and the subsequent years, rather than that we run an economy towards further spend out from people who got money, that people in state and local governments who got money that they didn't really need during 2021, but spent it out during 2022 and 2023. I'm focused on keeping room for the public investments that Paul and I agree are essential. I don't think it's a very strong argument to say sometimes the Fed was behind the curve and we got inflation, and sometimes the Fed overdid it and we got recession. Therefore, we should assume that the Fed will, on average, get it right and be able to keep things under control. I think the way to read that experience is that if we produce a very substantial overheat, the likelihood and the situation around the dollar and the fact that part of the story around GameStop is so-called stimmies from stimulus checks reinforces these concerns. I think the likelihood is that something adverse will happen, and therefore it's better not to do that experiment. So it seems to me that much the more prudent approach is to do exactly what Paul says is appropriate, which is to meet the need for this emergency in a generous way through this year, while at the same time planning for and providing economic support for things that will create jobs, help those who are disadvantaged, but also build the economy's capacity and create the wherewithal for more debt. So I'd like to see $1 trillion of public investment built into a $2 trillion program or a $2.5 trillion program to be legislated right now, rather than having by far the largest program in American history, whose advocates like Paul recognize that a very substantial part of it is in that third category, that is neither necessary to meet the emergency nor to provide relief for the suffering.
Thanks, Larry. So let me come back to Paul, and I would like to throw some additional element in it, which is politics, and Paul alluded to this already beforehand. How important do you think, Paul, is it that, you know, the Obama administration, when it came in, we had a huge financial crisis and the stimulus was too small at that time. And then when the elections came 2 years later, the Democrats were essentially voted out. And, and then there was still enough money left for a Trump tax cut, which was very generous. And then we realized the Nairo, the inflation was not popping up. So this experience from the last crisis, to what extent is this shaping now the political debate in Congress among the parties? What's your take on this? And is this trumping the economic reasoning? Is this the political things saying, okay, in 2 years' time, we would like to keep the majority the Democrats would like to keep the majority in the Senate and the House?
Okay, let me come to that in a second. I want to talk just about two substantive economic issues. First is, yes, if we're over, actually, three issues amongst the economic issues. First of all, it's not just the specific. I mean, the shots in arms is what Larry talked about, and that's a big slug of stuff. But also there's quite a lot of spending on other things, notably education, basically virus proofing schools, and that's very much, actually, that is a form of long-term investment, because getting kids back to in-person learning as soon as possible is an investment thing, very probably more important than any kind of infrastructure. But still, there is probably quite a lot of air in this stuff that is not really well targeted on people in need. On the other hand, trying too hard to make stuff well targeted, we're not able to make a very precise cut there. So a certain amount of stuff that is kind of scattered, maybe scattershot, with only some of it falling on the people who are most in need is okay. Now the question there then becomes, well, but isn't that setting up for excess demand the next few years? For what it's worth, I think of that as just an increase in household wealth, and the marginal propensity to spend out of wealth is not 0.5, it's something like 0.1 or less. So it's something that's going to be spread over an extended period. It's not a 2022 issue. It's a next decade issue. I know it's liquid, but it's still, and of course there, GameStop, yeah, people spending their stimmies, there's always going to be some of that. About the Fed, my read, when I tried to come up with something that looks comparable in scale to what I think the actual fiscal stimulus is going to be, I actually come up with the Reagan tax cuts and military buildup of the early 80s. And of course, what's hard there is that you had layered on top of that was the Volcker recession. So a very tight monetary policy, which was instituted before the tax cuts, led to a severe recession and then was relaxed, and you had mourning in America. But if you actually ask what happened after that, which was a situation where tight monetary policy was in effect trying to offset fiscal stimulus, it actually worked. We had basically a soft landing in 84, 85, and nothing terrible happened. Now, you can go through it, but the experience of the 80s, which is the most dramatic tight money thing that we see, but the story about tight money causing a recession is one that's before the fiscal stimulus. My read on that is that the Fed actually managed to handle the fiscal stimulus pretty well. Marcus, politics, of course, that hangs over everything. In fact, the reason why at some level Larry and I are having a purely academic debate, this thing is going to pass, and it's going to pass with a number very close to 1.9 trillion. And it's going to pass that way, and it's going to include a bunch of checks that are where the economic case is a bit weak. And the reason is because the checks are enormously popular. Democrats were badly burned by the experience of the Obama years, where an underpowered stimulus helped to lead to a Republican takeover of Congress. It's political stuff is just incredibly fraught. I mean, we're kind of mostly, I hope, in an insurrection-free zone here, but when you take a look at who the other party is and the urgency of doing stuff that is popular, especially when you've kind of promised it. I mean, the fact of the matter is that the Democrats hold the Senate in large part because their two candidates in Georgia promised people $2,000 checks. Wisely or not, the fact is the party is not going to go back on that. So yeah, the politics overhangs it. Now, I don't like that. I want to be a technocrat and not be thinking about what's going to move. But this is if I feel like a classic villain here. This is real life. You can't handle the truth. The fact of the matter is, the economic policy has to be contingent on the fraught political situation.
Thanks, Paul. Let me pick up on the 1980s. Of course, the 1980s, we had a high nominal interest rate. And I was just wondering whether, Larry, you could outline a little bit, and Paul can come back to this as well. What are the implications of hiking the interest rates? Will there be a soft landing, as Paul said? But I'm worried in the sense that, if you look at the 30-year mortgage rate, it's roughly 2.7%, inflation 2%. So it's really, half a percentage point of a real interest rate on mortgages for 30 years. And there would be, if the rates were to go up, the real rate goes up, what happens then to all the asset prices? There will be a huge reallocation on the financial markets. And what happens to the emerging market economies? Now, what happens if the US were forced to raise interest rates to some extent? What are the repercussions for the rest of the world? Perhaps if you can elaborate on that, on the implications of the exchange rate and the emerging economies in particular.
Let me just say that I think Paul makes a case that there can be some air. I think it's hard to get the conclusion that you're not talking about $1 trillion of air. And that $1 trillion that Paul recognizes as kind of air is the largest fiscal stimulus we've ever had in the United States. And so expressing concern about its possible consequences seems to me to be the right thing to do. I was careful in writing my piece to say that it was hugely important that we have a major fiscal stimulus program right now, that the egalitarian character of the Biden program was very positive, but that it came with risks that had to be managed. I think the risks associated with, and I can't say for sure that it may be that everything will materialize smoothly. But if you ask me about the risk that the economy will start to inflate, that it will be explained in terms of specific factors, that bubbles will emerge greater in financial markets, and that a Fed behind the curve will then lurch in a way that causes a recession and that has substantial adverse global consequences. If you ask me about the risk that we will just be inactive for a long time and discover ourselves in a new norm with much higher and rising inflation expectations, and that the flat Phillips curve that is now a cause of such celebration will become a major problem in terms of the difficulty of restoring stability. If you ask about the risk that a growing expectation that real interest rates are going to be low or negative forever drives extreme risk-taking that creates bubbles that then generate momentum that lead to substantial downturns and a structural break. If you add up all of those risks, and if you add up the way in which what I suspect will be the growing salience of those risks over time may inhibit spending on necessary public investment, it seems to me to be a much better course to lock in the public investment now, rather than to lock in the spending power for households. On one technical point, I'm surprised by what Paul said. I would have thought that it was certainly to be expected that if you gave middle-class families $2,000, $6,000, if there's a family of 3, checks, which they didn't spend this year in part because of COVID, I would have thought the best guess would be that the spending propensity out of them would be far greater than the spending propensity economists usually estimate from wealth, which is driven by fluctuations in the stock market. So I think the excessive, to the extent there are buildups of assets because of saving this year, the right assumption about the rate at which they'll be spent in 2023, 2022, 2023, 2024 is much greater than would come from normal estimates of the propensity to consume out of wealth. So I'd rather be locking in the public investment and the climate change than locking in the rest. And I don't think it's that hard, actually, to target pretty totally those only $20 billion lost wage and salary income. And I don't know what the argument is that you need to spend 5 or 6 times that in order to make sure you're reaching the people who need to be reached. And since even on Paul's calculations, that's such a large part of the program, I think that's a case that needs to be more fully articulated. And look, if this is a necessary political compromise, it's a necessary political compromise. But I think it's our job as economists to say that there isn't really a compelling economic case for it, that it carries with it risks that need to be managed. And then we're a democracy. And if our political leaders think it's necessary to reach a political compromise, that's a decision we should respect, having warned about the risks. But I don't think it's right for us to tilt our economic analyses in favor of what is a politically expedient conclusion.
Thanks, Larry. So let me among these risks, of course, I'm very interested in bubbles all the time. So I would like to know from Paul, do you think if bubbles emerge and there's a huge wealth generation from bubbles, people don't spend on it, but what happens if bubbles burst? What happens then? What will be the outfall from then? And then I would like to go a little bit to the role of expectations and the inflation anchor. So do you see any threat of the inflation anchor breaking at some point, or do you think that we're far away from this because it's now so ingrained in people's beliefs that the inflations will stay around 2%?
So let's, first of all, on bubbles. Bubbles happen. Trying to use macroeconomic policy, trying to condition your macroeconomic policy on fear of bubbles is very, very problematic. You have to be much more confident that you have a bubble than we usually are. There are occasions when a bubble seems to be as clear as anything. Housing bubble in 2005-06. But that was more the exception than the rule. And I will just say on the whole interest rates, which Marcus seems to be concerning you. I don't think I'm hearing this from Larry, but the concern that low interest rates are basically a bond bubble, and that tight monetary policy to offset fiscal stimulus will burst it. It could be, but I would have said, there's this hypothesis called secular stagnation, which somebody or other has done a lot to popularize, which leads me to believe that there are actually pretty good structural reasons for interest rates to be low, and to believe that they will, even if there is an interest rate spike in the wake of the American Rescue Plan, that it will subside and it will be back in a low interest rate world. I think that I'm still persuaded, not 100%, because 100% certainty just doesn't come with the territory, that we are still basically in a world of excess savings looking for some place to go, and that we're back there. It's funny, if in a way the closest parallel to the financial risk that I think is what Larry is saying, and maybe what you're saying, Marcus, as well, is something like a 1994, when the Fed tightened and there was this bond rout and there was a spike in interest rates, and we're certainly at the Fed, they worry about, that precedent is very much on their minds. But funny thing is, it didn't actually lead to a recession. In fact, the U.S. economy was still busy adding 300,000 jobs a month right through all of that. And so I'm not convinced that that's a big concern. We're getting so many things here. I mean, I would agree with that. The marginal propensity to spend out of, I think we're stuck calling them stimulus checks, even though they're not stimulus and they're not checks. But the marginal propensity to spend out of stimulus checks is going to be higher than the marginal propensity to spend out of stock market fluctuations, no question. And may be higher than the marginal propensity to spend out of housing wealth, which is higher, but not. Maybe I'm wrong, but there's reasons to think it's not that large. And look, if I had thought, I have to admit, I'm allowing political, trying not to claim that things are good when I don't think they're good, but I am allowing political reality to constrain the things that I'm advocating. A big infrastructure, a Build Back Better slug in this first package was not going to happen. The only way it's going to happen is if there's a lot of credibility built around the first package. And now it's possible that people a year from now will be saying, oh God, look, they overheated the economy, it was too big, and no more money for Biden. But what I think is more likely is people say, hey, I got my check, the economy is booming, these people seem to know what they're doing. But in any case, the economic constraints, the debt is not a constraint. In fact, aggregate demand is not going to be that much of a constraint. So it's all really about the political economy, like it or not. I don't want to play politics either, but like it or not, political economy is what's going to determine how much of an investment agenda we can have.
Thanks. So
Paul's much more confident that aggregate demand and concerns about financial stability are not going to be an important issue by the end of the year, given a program of this magnitude, than I am. He might be right, but he's much more confident of that than I am. I kind of agree with him. If you had asked me to make the case that I was wrong, I would have used the same example he did of 1994, where you did have a big interest rate spike, and you didn't have adverse economic consequences. I think the big difference between that environment and this one is that in 1994, we had a government that was organized around the theme of fiscal stability, deficit reduction, and bringing down the debt share of GDP. And a similar kind of scenario in an environment of double-digit budget deficits, it seems to me, would carry with it substantially more risks than what we had in 1994. There may be a difference between Paul and I in the extent to which one wants to make the best be the enemy of the good. I think in terms of economic analysis, the way we can make the biggest contributions is by warning about what the risks are, and by being clear about what would be the best opportunities. And it doesn't sound to me like Paul disagrees with me that if we did what was necessary to fight COVID, to remove schools and to get schools going, and then we did what was necessary to meet that $20 billion a month in lost wage and salary income, and beyond that, we focused heavily on public investment, that would be a better approach to meeting the needs of the moment. I think where we differ is that he's more optimistic than I am that on the path we're following, we'll get to more or less the same place with some non-optimal policy and some groundwork laid that will make the public investment more likely. He's more optimistic that this will prove to have been a very successful political route to getting to that than I am. But on the fundamental economic analysis, I think what I've found encouraging is that we have fairly similar views.
Thanks. So let me just move a little bit also to monetary policy as well, and Paul perhaps can elaborate on that. So you both argued actually that the central bank independence is not so important anymore, but this was under a time where we had fiscal constraint, fiscal austerity in many, many countries in the world. Would you still saying to manage the risk which might come along with the stimulus, do you think now central bank independence is more important again? So that there's, because you have now, of course, I agree that you have a high debt burden, a debt level, but with a low interest rate, the debt burden is not so high. So how do you see this? On the one hand, the debt burden for the government is not so high because the interest rate is so low, and there might be also less room for the central bank to move, or more political pressure. How important is central bank independence these days? Did it become more important now with this debate, or do you think it's still not so important?
Okay. Actually, I just want to make one more point, which I forgot to make earlier. I didn't. Which is that in this program there is a fairly large role, partially implicit, of automatic stabilizers. That if the economy does really well, first of all, the unemployment outlays, unemployment insurance outlays will come down, so that that component will be substantially smaller than is now being projected. And also, although this is the implicit part, if the state and local fiscal situation is substantially better than we expect, I think that they will bank a large part of the aid, so that the downside, if the economy has an upside, then that in fact is going to probably reduce the amount of stimulus that's going to be supplied. So I think that's worth saying. About, yeah, central bank, I think it's, there was a reason why central bank independence became a kind of a talisman, which was that we had a period of at least where it was perceived that inflationary psychology and political dominance over central banks led to bad stuff, and you can certainly see that to some extent in Arthur Burns, and you can see that the dash for growth in Britain and all of that stuff, and so we got to this position of central bank independence being crucial, and then, that was actually a response to an inflationary environment of that's long gone. Now, there is a question, if we're saying, okay, actually a lot of bad stuff happened as a result of central bank independence, it would be kind of a shame if we ditched it exactly as we approached the moment where actually the case for central bank independence is coming back. It would be, we would be managing always to be fighting the last war economically. I think we're quite a ways from that. The thing is that it took years. You don't unhinge expectations that quickly. It's not the case. It's simply, in fact, it's not the case that the moment that LBJ decided to have both guns and butter, that inflation expectations ran wild. It was years and years of bad policy judgment. And I don't really have any worry that the current US administration is going to try to bully the Federal Reserve into accommodating its fiscal policies. Who knows, what may follow, but God knows if we have another administration like the one that just left, I think central bank independence is going to be the least of our concerns, and it wouldn't persist anyway. So I just don't think that that's such a. I think that's an issue that we microeconomists tend to make a big deal, tend to regard, particularly because particularly macroeconomists of a certain age, with Larry and me we remember the 70s, but But I don't think we should be all that obsessed about the question of central bank independence, not yet. Much more, if there are concerns, they are the ones Larry is raising, which is that this is a really big fiscal package, and not to worry that Jay Powell is going to try and make it disappear or inflate it away.
Thanks. So let me throw this question also to Larry, but also combine it with an earlier theme Charles Goodhart put out in this webinar series, and he also wrote a book on. He argues that the low inflation, real interest rate era is over, which is very contradictory to Larry's secular stagnation. But he argues one reason inflation was so low was essentially that there was a huge labor force in China and Eastern Europe joining the global workforce. And that brought inflation rates down. It really put pressure on the trade unions and others, so the wage bargaining changed. And he argues, at least Charles Goodhart argues, this pressure will go away, and hence the low inflation era will not persist. Do you share these concerns at all? I think that's probably a much more long-run perspective. Your worries right now are, I guess, much more short-run concerns.
Look, I'm kind of under sort of the influence of a couple things. When I was in graduate school and my early years as a professor, the liquidity trap and zero interest rates was kind of an interesting historical thing that didn't seem terribly relevant to today's to the world of today. And then it became central. And I learned from that things have a way of coming back. And so I think there's a current generation of economists that finds, after 40 years of basically low inflation, where the inflation rate basically hasn't changed importantly in a generation and a half, it follows that any right-hand side variable is going to have a zero coefficient, predicting a dependent variable that doesn't move. And so inflation's kind of off the radar screen. And I think that's probably a mistake. And on top of that, you have a kind of psychological phenomenon. I kind of lived through the Japanese bubble of the late 80s. And there were a lot of people who were confident the Nikkei was overvalued at 25,000. There were even more people who were confident that it was overvalued at 30,000. And by the time it had gotten to 35,000, there were a lot of people with humility who weren't confident of anything. And so I think the fact that predictions of inflation have been wrong for a very long time, obviously is a probative fact on the one hand, but it's a fact that can be too probative. So I think the concerns about inflation accelerating, the concerns about expectations, which we don't understand very well, becoming unanchored, the concerns about what could happen to the dollar, I think in environments which you don't understand very well, it's a good idea to take small, careful steps, unless there's a compelling reason to do something else. And so when I look at an 18% of GDP deficit in a year when unemployment is predicted to be kind of like it was in 2015, I kind of think I'd rather see the energy pushed forward over the longer term into things that I know will do good in terms of public investment. And that just seems to me like the better approach. I think Paul and I agree and probably disagree with Charles Goodhart in thinking that the right best guess, considering all the forces, is that the idea that savings absorption is our principal macro problem is likely to be right as a way of thinking about the next decade. And it's just a question of, if you have that, how much should you be putting into place a program for the next decade to address that? And how much should you be doing all of this right now? It's like the question I think I referred to earlier of if you believe in an increase in the minimum wage, how should you feel if somebody wants to increase it to $22 for the next 2 years? You kind of like the idea that they're on your idea about increasing the minimum wage, but maybe this isn't the best way to do it. And that's where I come on the judgments now.
Yeah, can I just say, I mean, Larry and I are actually in many ways in similar wavelengths, and definitely just because something has been true for a long time doesn't mean it will always be true, and things do come around. And but it's also true that in some ways, if we're worried about an unhinging of expectations here, this is an extremely the sui generis nature of what's going on is some insulation against that. Seeing us run huge deficits in the face of an unprecedented pandemic is something that I do believe even that people, wage and price setters, financial markets, and so on, will largely treat as being a one-time event. I could be wrong about that, but I think the idea that it's going to suddenly be 1978 in people's minds again that's too far. If we continue to run, if we continue to do massive, diffusely targeted programs after the pandemic is over, well, then that would change. But I don't think that's going to happen. And just a word about the Goodhart point. I just worrying that this is stuff I'm actually supposed to know something about, and that sort of thing drives me a bit crazy. The fact of the matter is 70 to 75% of the workforce is in non-tradables. That the idea that wages are depressed, that we are unable to have labor organizing because of Chinese competition in our vast service sector really doesn't make sense. If you try to ask, why is it that why did Walmart not get unionized when it took over from General Motors as the biggest employer? That wasn't because of globalization. You can't drive to a Chinese big box store. It was because of essentially because of politics, because the giant service sector companies got giant largely during the Reagan years, and where both legal and illegal tactics to block union organizing were essentially given complete freedom of action. So no, I don't. It's possible that the low inflation environment of these past 3 decades is behind us now, but not for the reasons that Goodhart is saying, and mostly I think not, because basically I come back to it. I was vastly persuaded by Larry's secular stagnation argument. I think that we have a lot of persistent economic weakness, beyond this, beyond the COVID relief into the post-COVID world. It's going to be we're going to be back in the world we were, which is when we're creating enough demand and avoiding slowflation is going to continue to be the big problem.
Look, maybe a summary of some part of this, Marcus, is I think in some ways, Paul and I are in very substantial agreement. I think Paul and I both believe in 2 propositions. One, we should have a effective response, maximally effective, to winning the war against COVID and protecting its victims. That it's likely that will have been accomplished within a year, and that beyond that, we need a large-scale, effective program against secular stagnation. I think Paul is more confident than I am, though we're equally hopeful, that the current program will be the first step down that road and is the best way to move us down that road. And I am more concerned that the current program, because of its various overhangs, will become the defining program of this era and leave us less responsive to the overall secular stagnation challenge. But I think that our disagreement on that point should not obscure our agreement on a fundamental point where we are still at considerable variance with many in the economics profession and even more in the financial establishment, that our fundamental issue of our time is the absorption of saving. And it is that rather than the rise of Chinese labor or some kind of promiscuous profligacy on the part of central banks that is the way to understand the major economic trends that are playing out.
Thanks, Larry. So, Paul, I give you another minute to respond, and then I will conclude.
I think that's exactly. I mean, the truth is, we'll find out. I think Larry is. I think you're exaggerating. I think you're wrong. I'm not exaggerating. I think you're excessively worried about the risks, but I'm not sure of that. I'll admit that I'm not sure about that. And but it's a peculiar thing, because although this debate only started very recently, it's already pretty much moot. In fact, something that is, it now seems unlikely that it will be as small as 1.7 trillion. It's actually this thing is going to pass. It's going to pass with Kamala Harris's vote, and it's and then we'll find out and hope that it can be managed. And then you're right. I mean, I'd say actually the overriding issue is, of course, climate change. But the way to deal with that and simultaneously deal with the problem of secular stagnation is through a lot of public investment. So this behind us, that's where we should be going, and we'll see whether this massive thing, it is massive, whether this massive thing paves the way for that or gets in the way of it. And cross your fingers and hope that the optimistic view is right.
Thanks a lot. It was a pleasure to talk to you, both of you, and I think the audience really appreciated it as well. Let me just summarize. Perhaps there's a lot of agreement, so we always stop with a positive note. So both of you agree a lot. There's a different emphasis in some dimensions. I see that Paul is seeing more the political constraints, Larry is seeing more the risk dimensions, but at the baseline, there's a big agreement. And with this, thanks again. Fantastic. And great appreciation to both of you. Bye-bye, Paul and Larry.